Ladies and gentlemen, good day, and welcome to the Religare Enterprises Ltd Q1FY27 earnings conference call. As a reminder, all participant lines will remain in the listen-only mode, and there will be an opportunity for you to ask questions after the management's opening remarks. Should you need assistance during the conference call, please signal the operator by pressing star, then zero on your touchtone telephone. Please note that this conference is being recorded. I will now hand the conference over to Ms. Anishi Shah from Adfactors PR. Thank you, and over to you.
Thank you, Ryan. Good day, everyone, and thank you for joining us today to discuss the Q1FY27 business performance of Religare Enterprises and its subsidiaries. We have with us today the management of Religare Enterprises Ltd and its subsidiaries. Before we proceed with this call, I would like to mention that some of the statements made in this call may be forward-looking in nature and may involve risks and uncertainties. The company undertakes no obligation to update any forward-looking statements to reflect the developments that occur after the statement is made. Documents related to company's financial performance, including investor presentation, have been uploaded on the stock exchanges and on the company's website. I now hand over the call to Mr. Pratul Gupta, Chief Financial Officer at Religare Enterprises Ltd. Over to you, Pratul.
Thank you, Anishi. Good evening, ladies and gentlemen. Welcome to our Q1 FY27 earnings conference call. Thanks for taking out time today to join this session. Before I go further, I would like to invite Mr. Arjun Lamba, our Managing Director, to give his opening remarks, after which I'll take you through the group's performance during the quarter. I'll be covering the financial services side of the business, touching upon REL, RBL, RFL, and housing finance. Ambrish Jindal, my colleague at Care Health Insurance, will take you through the performance of insurance business. Over to you, Arjun.
Thank you, Pratul. Good evening to all of you. On the call, I welcome you to our Q1 FY27 earnings call today. I want to begin by sharing a perspective on what Q1 FY27 represents for Religare Enterprises. This has been a quarter of deliberate, measured progress for us. We are putting the house in order to build a strong foundation for the businesses. First, let's talk about the insurance business. Care has grown at a 37% YOY in GWP terms. We are the second largest standalone health insurer in the country. We are focusing on growth and doing good at it and hope to improve our ratios in the coming quarter. We have Ajay Shah and Manish Jodeja, who are our founding members at Care and who have been elevated to the roles of MD and ED respectively, and we have Ambrish here as well. Religare Finvest is well capitalized. I'll get to the NBFC next. Religare Finvest is well capitalized with a net worth of 915 odd crores and a healthy cash balance of 600 crores. We have Srinivasan Karthik at the helm. Karthik, a technology-first leader with 3 decades of financial services experience, who has joined us from HDB, is running the show. Karthik is busy building out and hiring, and we hope to commence business in the next 3 to 4 months. The housing finance team is focusing on restoration and rebuilding its franchise. The business has a net worth of roughly 180 crores, and we have about committed 250 crores for the capital to build this business over the next few years. Pawan Gupta has joined us as MD and CEO of Religare Housing. He was earlier CEO of Muthoot Housing Finance Limited. Pankaj Rathi, who is the CFO from Graham Housing Finance, has joined as the CFO. So you will be hearing more about this business in the next coming quarters. In our broking business, we are busy hiring and building out under the leadership of Mr. Vijay Goyal, who joined us about 6 months back. We are building out our tech platform. The broking business per se is off the tracks. We are building out our margin funding book and also looking to scale up our third-party product business. We hope to see productivity and efficiency gains in the near future. We continue on our journey to put the right building blocks for sustainable, profitable, scalable growth in the near future. Before I end, I would like to comment on our demerger scheme and the recent communication received from the Reserve Bank of India, which is a week old. I'm sure some participants will have questions around it. We are engaging with the regulators in this matter to answer any questions that they may have. We remain committed to the cause of delivering stakeholder value via this route. We will update you as and when appropriate on this matter. I just thought I should share this with you. Now I request Pratul to take you through the specific highlights. Thank you.
Thank you, Arjun. Q1 FY27 has been a quarter of deliberate building for us. We have completed critical leadership appointments across all 4 businesses. We have strengthened our capital base, and each of our business has continued to do intense work of preparing itself for the next phase of growth. Let me now walk you through the investor presentation, which has been shared with you and is available in the investor relations section on our website as well as on the bourses. I'll be referring to this presentation as I speak about the quarter. Referring to slide 4, while some of the audience may have seen this slide earlier, I would just like to refresh everyone's memory on our business overview. We have two segments, insurance business and financial services. While insurance is about Care Health, which is India's second largest standalone health insurance company, the financial services piece is constituted by Religare Broking, a securities broking platform with over 25 years of operations, Religare Invest Limited, our MSME lending platform, and Religare Housing Finance, our affordable housing finance business, which is a subsidiary of Religare Invest Limited. Moving to slide 5, it just illustrates the recent leadership hiring as well as reorganization of roles. We welcome all this leadership and we look forward to a great future here. Slide 6 captures the financial summary wherein on consolidated level, REL has reported a revenue of rupees 2,358 odd crores against rupees 1,876 crores reported in the corresponding quarter last year, marking a 26% year-on-year growth. The reported PAT is negative at rupees 46.98 crores, mainly due to different reporting standards. The slide also captures the highlights of each business, which we will cover as we move ahead in the presentation. Further, on the demerger, the company has received communication from Reserve Bank of India conveying that post the examination of our application, the request for approval has not been acceded to. The company's team is engaging with the regulator for necessary course of action in future. Moving on to slide 7, this is the consolidated performance for REL. We have reported a total income of 2,358 crores, whereas the total expenses are rupees 2,435 crores, resulting in a negative PBT of 76.73 crores. The numbers for the corresponding quarter was a positive 5.73 crore. In terms of segments, insurance business has contributed 2,229 crores, whereas financial services has contributed 133 crores. We will discuss the specific performance of each business in subsequent slides. On a standalone basis, being a non-operating CIC, REL has reported an income of rupees 4.38 crores and an expense of rupees 14 crores, resulting in a net loss of 9.62 crores for the quarter. I now move to slide 10. This is Religare Broking business. I'll quickly cover that. This quarter, our broking business delivered a strong rebound in profitability, supported by stable revenue performance. We continue to strengthen our product ecosystem by enhancing our existing trading platform, advancing the development of our next generation platforms, investing in talent across key business and technology functions, and driving process improvements to support scalable growth. Alongside our continued focus on security and governance, these investments are strengthening our platform and positioning us for sustainable, profitable, long-term growth. Now let me take you through some of the key business highlights for the quarter on slide 11. Total income increased 7% YOY to rupees 99.6 crores, supported by 13% growth in brokerage income, 28% growth in interest income, and 58% growth in client debit book. The PBT grew 47% YOY to rupees 10 crores. Assets under custody stood at rupees 47,946 crores as on 30th June 2026. Our revenue mix remained well diversified, with brokerage contributing 47%, interest income being at 30%, and e-governance at 16% of Q1 FY27 revenue. The balance was contributed by depository services and the distribution of third-party financial products. Moving on to slide 12, these are key ratios. As I mentioned, total income increased from 94.1 in corresponding quarter last year to 99.6 crores, representing 7% growth. The revenue growth was primarily led by core business segments. PAT, as mentioned, grew by 65% from 4.6 crore to 7.5 crores, reflecting improved operating leverage and profitability. On a consolidated basis, the net worth of Religare Broking Limited and its subsidiaries stood at rupees 384 crores as of June 30th, 2026. Moving to key business metrics on slide 13. Average daily turnover in the cash segment increased from rupees 334 crores to 375 crores, broadly in line with the market growth. Derivatives ADTO also registered 10% YOY growth. Unique trading clients remained broadly stable despite evolving market conditions. For the P&L, slide 14, total revenue at 99.6. Sequentially, this revenue has remained stable. Operating expenses have remained stable with the exception of employee costs, which increased largely due to strategic hiring across key functions and the impact of annual salary revisions. PBT for the quarter increased to 10 crores compared to 6.5 crores in the first quarter of last fiscal. Slide 15. Business is currently into a high-speed repair and investment mode. We have seen addition of new talent as well as gain in productivity, improving our technology platform and digital offerings, along with expanding the product platform remains our biggest focus before we start aggressive client acquisition. I am now moving to slide 17, which gives the overview of Religare Finvest Limited. RFL is part of financial services segment of Religare and is categorized as a middle layer NBFC. It currently has a core SME book of approximately 53 crores. The collection efficiency has remained stable at 98%. The PAT during the quarter was 15 crores and our net owned funds stands at 837.8 crores. RFL has robust capital position with tangible net worth of rupees 915 crores and a strong liquidity profile with cash balance of over 600 crores. Stable NNPA stands at around 0.8% and CRAR is at 238%, well above the regulatory requirements. With the joining of Karthik, the focus of the entire team is to ensure that the organization is ready for the next phase of rebuilding and growth. The cash is available, the capital is in place, and the platform is ready for whichever business line we choose to adopt. Slide 18 captures the trends of key ratios for RFL business. Total income for the quarter one stands at 14.4 crores compared to 19.3 crores for the corresponding previous quarter due to reduction in loan book and lower recovery from GNPA book, which has adversely impacted the profitability. Profit after tax for the quarter stood at 15 crores compared to 17.9 crores in quarter one of FY26. Collection efficiency, as I mentioned, is stable at 98% and NNPA is stable and under control. These ratios reflect collectively the financial strength of the platform and discipline with which the business is being managed throughout its turnaround phase. Finally, on slide 19, which is a detailed P&L statement, net interest income for the quarter is 13.5 crores as opposed to 18.6 crores for the corresponding quarter last year. This is largely on account of decrease in loan book size. Overall, the performance reflects the strength of the team to collect from NPA pool and add to the cash collections, which should position RFL well for the next growth phase. Coming to Religare Housing, I am on slide 21 now. RHDFCL's focus would be towards self-employed and informal segments in semi-urban markets as its clients, where we see immense potential to grow. Currently, we have around 15 branches in 8 states serving over 2,800 customers. Our aim is to build a granular portfolio backed by residential mortgage assets. Our average ticket size is at 12 lakhs. The organization has a AUM of 247 crores with product mix comprising 66% home loans and 34% loan against property. The company continues to maintain a healthy capital adequacy of over 121%, and we have investment grade ratings from ICRA and CARE to the tune of BBB-. Moving to slide 22, our focus remains firmly on attracting customers from self-employed and informal segment. There is a strong capital base of 180 crores. From industry perspective, the affordable housing finance continues to benefit from strong structural tailwinds, favorable government initiatives and increasing demand. On a positive note, the Indian retail credit growth story remains robust, with affordable mortgage segment continuing to witness leading healthy momentum. Slide 23 highlights the key operating and financial ratios for the company. The company reported a total interest income of 7.1 crores with an average yield on portfolio of 14.6%. The asset quality in terms of GNPA and NNPA is at 4.4% and 3.3% respectively. The company continues to maintain a comfortable capital position well above the regulatory requirements. On slide 24, we present the income statement. As I mentioned, 7.4 crore is the total income. Operating expenses were at 12.5 crores, resulting in reporting a loss of 5 crores for the quarter. This summarizes the performance as far as financial services segment is concerned. I now hand over to Amrish, CFO of Care Health Insurance, to take you through the insurance business in detail. Over to you, Amrish.
Thank you, Kapil. Good afternoon, everyone. During quarter one, the sector continued to leverage on GST tailwinds, delivering a 32% growth in retail health and an overall industry expansion of 22.4%. Care continued to outpace market trends, achieving growth better than the industry. Highlights for the quarter are as our retail business grew at 45% year-on-year on a full premium basis, with continued market share gains in retail health insurance. Our GWP grew by 37% again on a full premium basis. Company has raised capital of rupees 150 crores to rights issue during the quarter. Profit before tax basis in day for the quarter is 163 crores against 102 crores in the same period previous year. Gross OPEX ratio for quarter one stands at 31.2%, which has improved by 100 basis points as compared to previous year. Now let me walk you through the presentation. I am on slide 26. The company achieved a top line of 3,247 crores on a full premium basis with a growth of 37%. Wherein retail new business, it grew by more than 50% this quarter. We have a market share of 6.7% among industry and 24% within SAHI segment. Company has raised 150 crores through rights issue during quarter one and rupees 200 crores of subdebt in the month of August 2026. Care is consistently delivering high teens ROE on PBT basis. Now moving on to slide 27. Over the past 4 financial years, the company has delivered a strong CAGR of 30%. In the current quarter, growth stands at 37%. Our retail health market share continues to expand, currently at 12.6% of the industry and 21.6% among SAHI. While full premium-based industry data for retail health is not available, but just to give you a perspective, industry grew at 32% on 1/N basis and Care grew 18% higher than the industry, leading to a gain in market share. The organization is a multi-channel organization focusing on all channels, wherein proprietary channel contributes almost 45% of the total GWP. Additionally, this year, retail mix has improved by 3% on a YOY basis. Moving on to slide 28. The investment book in this quarter has increased by over 800 crores compared to March 26, driven by strong business growth and capital infusion during the quarter. Investment leverage stand at 4.3x. Portfolio mix consists largely of bonds and GSEC, which constitute 93% of the entire book. Investments are predominantly allocated to sovereign and highest rated instruments, and our debt yield are consistent in the range of 7.2 to 7.3%. Moving on to slide 29. As discussed in earlier slides as well, company has achieved a growth of 45% in retail business. Retail health persistency rate has improved significantly. Grievances per 10,000 policies and per 10,000 claim both have come down compared to previous year. Moving on to slide 30. This slide represents our digital transformation. 99.9% of the policies are issued digitally, along with 99.9% fresh digital premium collection. Over 85% of cashless claims are processed within 30 minutes. And we have a comprehensive portfolio of 44 healthcare products tailored to meet diverse protection needs. Moving on to slide 31. This slide highlights the key capability of company's robust mobile app platform. There are 13.2 million app installations and currently we have 1.4 million active users. It offers a wide range of features spanning online medicine, health checkup and wellness services to digital consultations. Average monthly doctor consultations are increasing by each passing year. And 67% of active retail customers are now available on the mobile app. Moving on to slide 32. This slide compares the company's financial performance across all the accounting methodology, Ind AS, N and 1/N basis. Under Ind AS, as highlighted earlier, profit before tax stood at 163 crores compared with 102 crores in the same period last year. The combined ratio under Ind AS has improved by 30 basis points to 102.6%. Return on equity based on PBT increased to 5.2% from 4.2% in the previous year. On an N basis, profitability improved by 4%, with profit before tax rising to 69 crore from 42 crore in the same period last year. On a 1/N basis, profit before tax stood at 131 crore of a loss compared to 19 crore of loss in the previous year corresponding quarter, largely because these are the transition years on a 1/N basis. Moving on to slide 33. So the highlights of the results given in the previous slide. This slide gives a breakdown on Ind AS P&L. Under Ind AS, the insurance revenue as in Q1 FY27 stood at 2,947 crore, which grew by 28%. Insurance service results are in the same range as compared to previous year, and again, combined insurance service ratio has improved by 30 basis points. Slide 34, it gives the numbers on a 1/N basis, which again, as I spoke, is a transition year and hence not comparable with the previous quarters. That's from my side. Handing over back to you. Thank you.
Thank you, Amrish, for the detailed presentation. We are now ready to take questions. Back to you, Hanishi. Thank you.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Also, participants, in the interest of time and fairness to others, we request you to restrict to 2 questions per participant and rejoin the question queue for further questions. We take the first question from the line of Naresh Naikar from Systematic Shares. Please go ahead.
Yeah, good evening, sir.
Hi.
Hello.
Yeah, please go ahead, Naresh.
Yeah.
We can hear you.
Yes, sir. Yeah, this question was regarding the demerger. So in that circular, it is nothing mentioned about specific reason for declining. And can you please specify what specific concern RBI has raised regarding, is it related to capital structure or promoter or shareholding pattern? And second question, sir, regarding follow-up on value unlocking, is there any another plan to partial demerger like stake sale of Carrier's Insurance or listing just one entity if RBI objection is not fulfilled?
Hi, thanks for the question. So basically, the letter is brief and simple in what we put on, and that is the engagement with the regulator. They have not. There is no reasoning has been attached. We are now will be engaging with the regulator going forward, and we will figure out what the reason is, and if we can come up with a better alternative that satisfies the regulator. That's one. At this stage, that remains our priority focus. We are not looking at anything else currently other than figuring this out, and then after that, at an appropriate time, we will come back.
Okay. So can you please advise approximate what timeline it will take?
I mean, I cannot give a timeline, but we will make our best effort. That is what I can assure you.
Okay. Thank you, sir.
Thank you. We take the next question from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Good afternoon, sir. Sir, I had a few questions. So first of all, on CARE, so our combined CSIR ratio is like 102.7, and this is like meaningfully higher than some of the other peers who have reported the results. So if you can give some color on that. And also I see that your insurance service results is a negative of 3 crores. So, but if I just do the maths on 3,000 odd crore of revenue with a 102.7, it should come to be like 70-80 crores of loss. So if you can explain the difference.
Yeah, first question, I am Ajay Sarvesh. So first question I am taking. Second one I'll pass on to my CFO, Amrish Jindal. On the combined ratio, even if you see our track of last year, we started with 103 in the Q1. Finally, it landed at 101.1. So this is because we write many what you call corporate wellness book where there is upfront claims payment. So that is the only reason for this. It will finally come down to the guideline which we had given in the last call, Last call I had said very clearly that we want to become 100% in next 2 years, and we are sticking and committed to that. And on the second question, I will request Amrish.
Yeah. Hi, Sarvesh. Amrish this side. So you rightly said that if we do a maths on 2.7% on the revenue, we get a higher number. So CSR includes non-attributable expenses, and all the expenses, they need to be bifurcated into acquisition costs, maintenance costs, and non-attributable costs. So insurance service result does not include non-attributable expenses, but while computing CASR, include those non-attributable expenses. So if you look at the presentation, after net finance result, there is an expense item of 66 crores that gets added in the computation of CASR. So if we add this into insurance service result as well, you'll get the maths.
Okay. And this 37% odd growth, if you can break it up between fresh and porting and, growth from the existing book. So what is driving it? How much is being driven by, people going for higher sum assured or because of inflation in the premiums that we are charging? If you can give some color on, what are the drivers for this sort of a growth?
So Sarvesh, again, I think there are few moments in the industry which are a land grab moments. Once it happened after COVID. Second, after GST relaxation, we are finding it a land grab moment. So few questions, one by one. Number one, our fresh business is growing the fastest among all. So it's higher than my renewal business growth. That is number one. Number two, my number of consumers are growing faster because my growth is primarily coming in tier 2, tier 3 geographies. So my number of consumers are growing handsomely. Then the average ticket size and premium increase.
Okay. Okay, sir. Thank you and all the best.
Thank you.
Thank you. We take the next question from the line of Mukul from M&K Capital. Please go ahead.
Hi, good afternoon. Congratulations on good numbers. My question is for Ajay from CARE. Just the first part which you explained right now, it seems that retail has grown faster than corporate, and our retail share is still higher than the corporate share. While I understand that you book more corporate business in the first quarter, but from a mixed perspective, it does seem that retail has outgrown corporate, and yet our losses have come 1 point higher compared to some of the other peers where similar practices are there. So just wanted more flavor on loss ratios. That is one. And second, in terms of growth, while, GST is given a fillip, any guidance on where you see full year growth, given, very good set of numbers in terms of growth for the first quarter in the insurance business?
Yeah, this is Ajay. So we cannot comment on the full year growth. Till now, the market has been supportive, and we'll continue to ride the market as it grows. Number one. Number two, no, our quarter one is not necessarily corporate driven market. Our corporate businesses is scattered well within the year. Quarter one is highly skewed on corporate employee wellness driven, which is a bit different than corporate employee. And our retail definitely does better than corporate even in quarter one.
Got it. So, sir, any guidance on growth?
We intend to beat the market, that's all.
All right. Can I just squeeze in one more question if okay?
Sure, please.
Yeah, just on the accounting, now I understand that, IRD has transitioned to Ind AS accounting. And I did see the notes on Concall also, they are under Ind AS. So I was, I couldn't sort of understand why under Concall accounts CARE actually shows a loss. Because that is also Ind AS and standalone CARE is also Ind AS. So if you can just explain me that, I couldn't follow that.
Yeah, hi Mukul, Amrish this side. So I think the regulator has come up with the implementation of Ind AS effective 1st April 26. We as an organization, we took a forbearance of 1 year from the regulator to stabilize the technology and all this stuff. And hence the reason the impact of India's 117 is not flowing into consolidated accounts, and hence the reason the consolidation looks on the negative side, and Care Health Insurance standalone results on Ind AS are looking positive. So that's the only reason.
Super. Thank you.
From next year onwards, we'll start seeing both the accounts or both the console results and Care Health Insurance results to be same.
Yeah. No, it came from a fact that, we are actually market leading ROE business in health, and the console necessarily doesn't give the right picture. So the comment was from that perspective.
Yeah.
Thank you. We take the next question from the line of Amit Tawani from Clear Blue Capital Advisors LLP. Please go ahead.
Hi. Thank you for taking my question. My first question is, I was just looking at the leverage, and our leverage is in the presentation, it is 4.3, which seems to be on the higher side for like a Sahi business. Any comments there?
No. This year-end by census will be reduced to around 3.7. Additional capital will be infused this year.
I think capital has been earmarked by the promoters through the raise of the pref, and I think some part of that capital will be flowing through, and I think that should level of the leverage ratio should come down over time.
Okay. My second question is that, in the retail growth, how much is fresh growth and how much is port-in?
See, I don't have that numbers. What I can tell is my percentage share of port has come down drastically from last year.
Okay.
Yeah.
Okay. Okay. And I think that's it. I have no other questions. I'll come back in the queue.
Thank you. Thank you.
Thank you. We take the next question from the line of Meet Bua from Integrity Ventures and Partnerships. Please go ahead.
Hi, sir. I think we are seeing losses in the financial services business, and I'm sure that is because of the investments that we are doing to fund the growth that company is looking for next phase. I wanted to understand what kind of numbers or what kind of growth or AUM kind of numbers the company is looking at in this financial services business.
So I'll just answer that question. Where the CEOs have just joined, some as late as early as late as 1 month, and Karthik has joined us about 3 months back. What I can assure you is that we are adequately capitalized. The NBFC has a capital of about 1,000 odd crores. The HFC has a capital of about 200 crores, and this will be further topped up by about 250 crores. So we do believe that with 1,500 to up to 1,000 crores of capital, we have ambition for about a 15,000 crore book size. I think we'll be able to come back on the plans. The business teams are busy working their AOPs and all, and we'll be coming back to you. But be rest assured, we are ambitious about this business, and we will capitalize this business at an appropriate stage as and when capital is required.
Okay. And just another question on broking business. I think in broking business, there has been a revenue degrowth quarter on quarter. Just a second, I will also open.
Hi, good afternoon. I'm Vijay Goyal. So as Pratul mentioned, that we are in the process of repairing our business. So a lot of things we are correcting, and markets were also not particularly supporting. So this is just a temporary blip in the business. As we build the new technology platform and new products, we have seen the productivity gains. The annual increment happened. After that, the natural attrition also in the business happens. So that was a small reason. Because of this, there's a small drop in the broking side revenues. But our debit book has gone up and our interest income has actually gone up. So we have to be.
Yeah. Please.
Go ahead, please.
How are we planning to compete with the existing broking players? Like what kind of mode that we are bringing in where the market is already cluttered with multiple brands focusing on niche and multiple brands focusing on full service business?
To this answer, you have to wait. We are currently doing this repairing, and the clear direction that what kind of model will be built will be clear to us in about 1 or 2 quarters. And we'll be happy to discuss and report it to you that what kind of model we are going to build.
So currently, we are playing for productivity and efficiency gains while the work is going on. And I think in the first quarter, we have grown our income, broking income.
So, just to add on this is Triloki from Religare Broking.
Yeah.
So our quarter one revenue has grown up by 7%, as we said in the presentation also. And this is also grown up from the immediate preceding quarter also.
Sequentially also.
Sequentially also it's grown. It's not a big
marginal growth, but there is a growth. So I think we. I think work is in progress. I think things are happening. As you can see, this is our first quarter. Rest will be also dependent on the vagaries of the market. But our idea is to increase market share as we go forward by also increasing our other businesses, whether it is the margin funding book, whether it is third-party products, because we do have a platform and we believe there is enough room and scope for to go. But your question is very valid. It's a scattered industry. There are a lot of people. They're doing niches. What will we do that is different from anybody else? But as Vijay said, we'll come back to you on that.
Oh, thank you so much and all the best to the team.
Thank you.
Thank you. We take the next question from the line of Raj Lokhandwala, an individual investor. Please go ahead.
Good evening. Thanks for the opportunity. So my question is regarding the competitive intensity on the health insurance side. So how is it shaping up in the recent years, and how is it affecting the profitability in different segments, the retail as well as the group? Thank you.
So thanks, Raj. So intensity is high on the health insurance. We all understand it and we know that. With newer players coming up in the market, the intensity only has to go up. But what is helping the industry is, if you look at the industry, even the regulator and hospitals have come together on defining few things. At the industry level, there are a lot of guidelines which the GIC has laid down. I would call them as protocol. They are not GIC led. It is government led guidelines, number one. Number two, WHO led guidelines, which GIC has educated the industry. Number two, they are also making a lot of positional statements. Positional statement on cataract and this. Number three, with the blessing of the chairman and CII, the distrust between hospital and the insurance company is bridging gap. And two major things in that particular piece is NHCX adoption by the hospitals. Number two is what you call proper code of conduct both by insurance company and the hospital. All this, my sense, will bring about the profitability in spite of competition intensity.
Okay, fair enough. And second question is on the proposed demerger. So now that the RBI has rejected the proposal, is it fair to assume that the tentative deadline of Q1FY28 would be slightly delayed?
Yeah, I mean, I would like to think that is correct. But again, how much, what happens? I think when you engage with the regulator, we will get back to you. But that would be a fair assessment as of now.
Sure. Thank you.
Thank you. We take the next question from the line of Yash Mata, an individual investor. Please go ahead.
Hi, good afternoon, everyone. My first question is, what is the plan for equity raised by Care Health Insurance since its solvency ratio is now down to 1.58% as against requirement of 1.5?
Hi, Yash. So I think we have a solvency of 1.58 as at the end of June 26. We always planned to raise a sub-debt in the first quarter, but since capital market was in turmoil at that point in time, and hence we waited for that, and hence there has been a sub-debt raise of 200 crores in the month of August 20. So I think that solves us as of now for the solvency. But as far as the equity capital is concerned, we have a plan to ensure that the solvency remains at 1.7x. So we'll be taking appropriate action at the appropriate point in time, whether we need to further raise capital through equity or through sub-debt, but we'll ensure the solvency to be at 1.7x. So I think that is what will be driving us.
So I would also like to chip in from Ariel's perspective. I think Ariel and the other promoter, Kedara, both of them have stepped in and put money in whenever money is required. And as per our prep document, I think Pratul 360
Yes.
crores.
So, out of 600 crores, which has been earmarked for CARE, between the two rights issue, which happened in September 2025 and June 2026, we have already infused over 365 crores. And the remaining amount, as the warrants get converted, shall be available for appropriate
So
infusion.
from Ariel's perspective, that whenever they need money, we are happy to fund, because this is our growing business. This is the star, this is the crown in the June currently, and we will fund this. And I mean, there's no doubt about that from our end.
Okay. Thank you.
Thank you. We take the next question from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Yeah, thank you, sir, for the follow-up. On the recovery side, so I can see that this quarter we have collected around 20 odd crores from the written off book, I think. So what is the existing pool of written off accounts which is available for us to collect from? And, right now we are collecting 20 crores, but as we are putting in a new team, can we expect this collection to meaningfully go up? And how much do we want to collect, let's say, every year for the next 2-3 years?
So the pool is roughly around 350 to 400 crores of written off book from which these collections are happening. In terms of visibility, in terms of how this will go quarter on quarter, this is an old book. There are complications in terms of litigation, repossession. These are secured loans. So while we give some guidance in terms of what the annual operating plan is, exact numbers is something which only time will tell in terms of how it is. But it's a dwindling book. I think the legacy NPA write-off recovery also will start coming down every quarter.
But our best effort is on with each of these cases. We have a team, because it is 350, 400 odd crores, like Karthik said. We have a team that is focused on this. And whatever recoveries have to happen will probably happen in the next 2 years.
Okay. And finally, on the demerger side, so, understand that this RBI application was rejected. Now, earlier shareholders wanted a cleaner demerger for maybe Care Health Insurance instead of the financial services company, which would have reduced the holding company discount. So, given that we have also seen some promoter stake increasing, so how are we looking into that option, and is that option also on the table to sort of do a clean demerger for Care instead of the financial services business?
Sarvesh, so there is a new IRDA guideline that has come out that talks about the collapse of a non-insurer into an insurer. I think that's just come out. We are evaluating that. More importantly, we will look to unlock value, but the RBI permission is needed whether we do this demerger or the other one. So I think that is of utmost importance to us to engage, which we are, with the regulator, and get their views and try to assuage them and understand what the regulator wants us to do. So I think that is a precondition to both.
Okay. Thank you.
Thank you.
Thank you. We take the next question from the line of Amit Thawani from Clear Blue Capital Advisors LLP. Please go ahead.
Hi, sorry. I don't know if these questions were covered in previous calls, but just trying to get some clarity here. The RFL net worth is 914 crores and the AUM is only 53 crores.
Correct.
Yeah.
So,
It is sitting on a cash of over 610 crores lying in the bank in terms of, various securities. That's the collection for the business.
So what was your question, Amit, regarding what was the question?
There is some background.
My question is that why are we sitting on so much cash in that business? Is there a lack of opportunity or something?
No, Amit, so this is, if you go back in history, there was a period of time when the entire activity, lending activity was under embargo, and then the new promoters came in, so a lot of legacy issues which had to be cleaned up. And I think we are at a point of time when we are rebuilding the entire technology stack, launching the product. So a lot of what you see is basically lack of any business for the last 6-7 years in terms of new disbursement. So while the net worth has not got really eroded, I mean the cash has been sitting on the balance sheet. You will see that the profile changing significantly over the coming quarters.
To answer your question, Amit, we want to start business, which we are now aiming to in the next quarter or two, or maybe less than 2 quarters, about 4 months as we speak from here. And this cash to be put to use so that we can justify the cash sitting in and have a healthy ROE on this cash.
Okay, excellent. But I'm seeing a similar case even in Religare Housing, where our AUM has not gone anywhere for the last 1 year.
So again, because RFL was under PCA, under CAP, and Religare Housing was the subsidiary, it could not access market funds for the last 7 to 8 years. And hence its book started to shrink and had to shrink over time. But now your question is right, looking at it from today's point of view, but this will correct like Karthik has said with the NBFC as well.
Got it. And my last question is, I have actually two questions. The equities in care that we are taking in our investment book is at 5%. Are we looking to increase that? Because we are seeing some other insurers taking a bigger bet on equities, and we don't need to take a stock-specific bet, but maybe if we can, have a higher exposure to equities. Any thoughts on that?
Sarvesh, at this point of time, we want to maintain around 5, but at the right time, we'll continue evaluating.
Okay. And as far as the
I would
capital...
request you to please join back the queue for follow-up questions.
Yes, I will. Yes.
Thank you. We take the next question from the line of Meet Bua from Integrity Ventures and Partnerships. Please go ahead.
Just a clarity on demerger. So, is company exploring opportunities to demerge care instead of financial business? I just want to consolidate the thoughts. I think this question has been discussed multiple times, but just want to consolidate the thoughts on that.
No. This is not we are engaging with the regulator. Only post that will we do anything, and that this is not under consideration at this particular point of time.
Okay, got it. Thank you.
Thank you. We take the next question from the line of Lala Ram from LRS Capital. Please go ahead.
Good evening, gentlemen. I have 2 questions. Number 1, in terms of value unlocking, if demerger does not happen, do we have a plan B, or we continue to remain in the current structure? Question number 2 is how much warrants are remaining to be converted, and what is the timeline on that? Thank you.
Lala, your line is a bit echoing, but what we could understand, question 1 is around the option B. So as Mr. Lamba mentioned, right now we are just engaging with the regulator.
So any value unlock that can be done or should be done requires the RBI approval and the regulator's approval. So first we will try to address and rationalize with the regulator whatever the queries the regulator has. And after that, we are open to unlocking value at an appropriate stage, but this remains our priority number 1 to try to figure out.
Got it.
And on the second question, we collected 25% of the overall raise, which was 1,500 crores, that is 375 crores in September 2025. Thereafter, there have been multiple conversions. As of today, including some conversions which has recently happened in August 2026, we have 618 crores of proceeds out of 1,500 crores. And what is left is 881 crores, which is due for conversion by March 2027.
Got it. Thank you so much.
Thank you. Thank you.
Thank you. We take the next question from the line of Karina Kaur from Stockbloom Investments. Please go ahead.
Thank you for the opportunity. My question is in regards to CARE. So with CARE planning to raise an additional 150 crore of capital through rights issue and 200 crore through Tier 2 capital, which is also mentioned in your IP, could you give us some color on the key areas of deployment? Also, how you see this capital supporting growth and profitability going forward?
Hi, Karina. I think as far as the deployment is concerned, this capital was only required to support the growth from the business. So the entire money has been invested as per the regulatory norms of investment of IRDAI. And I didn't get your second question, if you can repeat.
So second question was about 150 crores of equity and 200 crores of sub-debt, which has already been raised, Karina.
Which has already been raised.
So quarter one saw a equity raise of 150 crores by CARE, and as Amrish mentioned, in the current quarter, the company has already raised a sub-debt of 200 crores.
Okay,
and the same has been deployed. Yeah, thank you.
Thank you. We take the next question from the line of Amit Thawani from Clear Blue Capital Advisors. Please go ahead.
Yeah, just trying to understand the next round of capital raise by CARE. Will that also be a rights issue?
Yes, most probably it will be a rights issue. Yes, it will be a rights issue as things stand today.
Okay. Because I was hoping that Religare can give a CARE can give a pref to Religare so that we can increase our stake in CARE.
So we maintain our stake, Amit, as mentioned. So largely in every rights issue, Religare Enterprises subscribes not only fully to its quota, but there is always some additional subscription. So if you see the trend, there has been a marginal uptick in the stake held by Religare Enterprises in CARE. I'm sorry, Amit, there is a lot of background noise. Yeah, I think you are on the road.
Okay, let me see what I can do about that.
The next issue, Lagrai.
So you can proceed. I have just muted Amit's line.
Next question.
Amit, you can proceed, please, with your next question.
Thank you. Just one last question. I don't know if my understanding is right, but at the time when the Burmans took over Religare, I believe the approval that RBI had given was a conditional approval. And that condition was that the Burmans would have to merge their NBFCs, which they own privately, into Religare. Is that understanding correct? And could that be a reason why this scheme was, rejected? Because RBI was expecting a composite scheme where a merger of the private NBFCs would be included in that scheme.
So, Amit, there is a slight gap in understanding the RBI letter. When it comes to the approval, as far as the situation is concerned, there is a set of NBFCs within the Religare fold, and then there are privately held, NBFCs. The observation of RBI is not about merging the two sides of business.
And that was a condition. Those conditions have been given. RBI has approved our directors, and RBI has approved our takeover and control. So we will, we are not aware of this. And we are not aware of it. This was not part of the letter, and we are not aware of this. Rest, when we engage with the regulator, we'll update as and when there's something concrete. Thank you.
Thank you. Ladies and gentlemen, we take that as the last question, and we conclude the question and answer session. I now hand the conference over to Mr. Pratul Gupta for his closing comments.
Thank you, Ryan. Thanks for this session. As always, we thank all our shareholders and other stakeholders for their interest and trust in us. For any queries, we are available at the contact details as mentioned on the last slide of the presentation. I thank everyone once again for taking out time and wish you all a great evening.
Thank you so much. Bye-bye.
Thank you. Bye-bye.
Thank you. On behalf of Religare Enterprises Ltd, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.